I would suggest is mixed. I'm referring in particular to the U.S. economy. There's some self-inflicted wounds, of course, around tariffs. The underlying economy is not bad. It is, in fact, good for people who have really, truly marketable skills. Unfortunately, a lot of American society doesn't have marketable skills. The softness we're seeing in certain commodities, in particular oil and gas, suggests that the overall economy is not as strong as people would have it. And it's been a very long time since we had a recession. This is not a call because I'm not an economist. I would merely state that one would expect the oil and the gas price to be higher relative to production plateaus in the U.S. were the overall economy strong. I note, too, that despite the relative strength in the U.S. economy, that there's a lot of political pressure in the United States to cut interest rates, which is an odd thing to do. With CPI stated inflation fairly stout, and the overall economy is very strong. It speaks to the politicization of the U.S. economy. And I think that this inflation and this politicization on top of the debt and deficits experienced in the U.S. and in other countries is an easy way to explain and an accurate way to explain the incredible strength that we've seen in the gold and gold equities markets this year. I think the gold price in the last 18 months, well, really the last 24 months, is really indicative of the fact that the reckoning is really and truly upon us. Let's look at it arithmetically. The on-balance sheet liabilities of the U.S. government, and I'm not going to talk about other economies, which are in mostly worse shape, but the on-balance sheet of the U.S. liabilities, of the U.S. federal government, not state and local government, exceed $37 trillion. And that's the number that the naysayers focus on. But the truth is worse. The off-balance sheet liabilities of the U.S. government, represented by entitlements, Medicare, Medicaid, Social Security, federal pensions, military pensions, that number is estimated by the Congressional Budget Office at $120 trillion. Now, to put that $120 trillion in perspective, gross federal income at the United States, revenue into the federal government from all sources, before they do anything like pay salaries or bomb foreign countries or whatever it is they do, is only $5 trillion. So you're trying to satisfy an obligation with a net present value, not a nominal value, a net present value of $120 trillion on gross income of $5 trillion before other expenditures. That doesn't work. There's two ways out for the United States. One would be an honest default, which is where you say to the bondholders, yes, we realize we owe you $37 trillion, but we don't have it. And you say to the Medicare and Medicaid recipients, the Social Security recipients, say some old codger like Rick Rule, yeah, you paid in for 60 years. That's right. We understand. But there's no money. So we're going to renege on part of our promises. That honest default isn't going to happen. We're in the midst of a dishonest default where we honor the nominal value of our obligations to our bondholders and to entitlement recipients, but we inflate away the net present value. My belief is that over the next 10 years, in an absolute sense, the U.S. dollar will lose 75% of its purchasing power. Not in a relative sense. I don't think that the U.S. dollar will do badly against the pound, against the sterling, against the Canadian dollar, against the Australian dollar. Countries that have the same circumstance, but maybe less resilience than the United States. But I do believe that in an absolute sense, the U.S. dollar loses 75% of its purchasing power. That's a consequence of the fact that we've lived beyond our means for 40 or 45 years. The gold price, I think, is a reflection of that. I'm not certain that the gold price, which has risen in nominal terms from $253 an ounce in the year 2000 to some number exceeding $3,700 today, I'm not certain in a real sense that the gold price is up at all, but in a nominal sense in US dollars is up 9% compounded. I would suggest to you that as a consequence of our society living beyond its means, that the increase in the gold price represents the deterioration in the purchasing power of the US dollar, represented by the deterioration in confidence that U.S. and foreign savers have in the integrity of the U.S. dollar. People ask me what would cause me to sell my gold. I say a cessation of the problem. If I saw some chance of a balanced budget in the U.S., by budget is in excess of $2 trillion in deficit today, or if I saw the ability for a political resolution of the entitlement liability, or if I saw positive real interest rates in the United States. By positive real interest rates, I mean an interest rate on the U.S. 10-year Treasury that was in excess of the rate of the deterioration of the purchasing power of the U.S. dollar, then I'd sell my gold. I believe that while the official statistics around inflation, the CPI, suggests that inflation as defined by the U.S. government is running by 2.9% a year, inflation defined as the deterioration in the purchasing power of the U.S. dollar relative to the basket of goods and services acquired by U.S. families. By that definition, I would suggest to you that the purchasing power of the U.S. dollar is declining at about 8% compounded. A real interest rate, then, would mean that the U.S. 10-year Treasury would have to yield some number in excess of the rate of deterioration of the U.S. dollar. The U.S. 10-year Treasury right now yields about 4.5. In the circumstance that would cause me to sell gold, the U.S. 10-year Treasury would have to be yielding 10 or 10.2 or 10.5, a circumstance that I don't think will occur. I think as a consequence of negative real interest rates, on-balance sheet liabilities and off-balance sheet liabilities, and the need to print to honor the nominal, not real value of those obligations, that the purchasing power of the U.S. dollar declines by 75% over 10 years, and at least the nominal gold price likely mirrors that decline over 10 years.
You know, people keep asking me lately, Rick, what's your take on the economy? And my honest answer is, it's mixed. There are parts of the American economy that look perfectly fine, even strong. If you've got genuinely marketable skills, you're probably doing just fine. If you're a welder, an engineer, a software developer, or someone producing something tangible, you're likely busy. But for the many Americans who've spent decades chasing degrees that the marketplace doesn't really need, well, it's a different story. A society that neglects hard skills ends up with soft results. Now, don't get me wrong, I'm not here to cry doom and gloom. The United States still has resilience baked into its DNA. But what worries me isn't what's broken, it's what's self-inflicted. Tariffs, for instance, they're like economic self-harm wrapped in patriotic slogans. Politicians like to sell tariffs as tough love, but it's more like taking a hammer to your own foot and declaring victory because you hurt yourself before your opponent could. They raise costs, distort markets, and trigger retaliation. Nobody wins. Then there's the energy market. Oil and gas are canaries in the economic coal mine. When the economy's running hot, energy prices reflect that. But lately, softness in oil and gas tells me the real economy isn't as robust as the headlines suggest. The US is producing plenty, but the prices don't match the booming narrative. If this were truly the strongest economy in the world, crude wouldn't be struggling to hold $70. Natural gas wouldn't be gasping below $3. These are not signs of an economy firing on all cylinders. They're signs of an economy with a timing belt about to snap. And here's the irony. Despite all this supposed strength, there's enormous political pressure to cut interest rates. That's bizarre. Historically, rate cuts are for emergencies, recessions, crashes, crises. Yet now politicians are screaming for cuts while official inflation is still stout. As the bureaucrats put it, it shows how politicized our economy has become. We've gone from an independent Federal Reserve to a political football field where every election season means someone shouting, "Lower rates," as though borrowing cheaper money fixes moral hazard. That, by the way, is why gold has been screaming higher. The price action in gold and gold equities isn't some speculative mania. It's a barometer of distrust. The market's saying, we don't believe the official story anymore. For years, the financial press treated gold bugs like relics from a bygone age, muttering about hard money while everyone else surfed the waves of quantitative easing. But here we are. Gold has risen from $253 an ounce at the turn of the millennium to north of $3,700 today. That's roughly 9% compounded over 24 years. And I'd argue that's not even a gain. It's just gold doing what gold always does, quietly mirroring the decline of the dollar's purchasing power. Because make no mistake, what we're seeing isn't prosperity, it's debasement. Let's run some arithmetic. The on-balance sheet liabilities of the U.S. federal government exceed $37 trillion. That's the number everyone talks about. But it's the off-balance sheet stuff, The entitlements, the pensions, the unfunded promises, that really matter. Medicare, Medicaid, Social Security, federal and military pensions. The Congressional Budget Office estimates that pile at around $120 trillion, and that's using conservative assumptions. Now, to put that in perspective, total federal revenue, that's all the taxes, tariffs, and fees the government collects, is about $5 trillion a year. Before they pay salaries, before they fund the Pentagon, before they even fix a single pothole, they're staring at $157 trillion in total obligations against $5 trillion in income. That's like earning 50 grand a year and owing $1.5 million. You can call your accountant, but no spreadsheet's saving that. So what happens next? There are two ways out, one honest, one not. The honest way would be to admit insolvency. Tell the bondholders, we can't pay you. Tell retirees like me, sorry, we don't have the money we promised. But politicians don't do honesty, so instead they'll choose the dishonest default. They'll pay everyone the nominal amount owed, but they'll do it with dollars worth far less. Inflation is simply the elegant name for theft by dilution.
We in the United States dealt with it at the end of the decade of the 1970s. We allowed the interest rate to rise to market levels, which is to say 18%, which broke inflationary expectations, broke a lot of people too. And while we didn't reduce the size of government, we reduced the rate at which government increased. The Reagan Revolution, despite its sort of vaunted anti-government stance, was derailed by politics. We didn't reduce the size of government at all, but we reduced the rate of growth of the U.S. government in the period 1980 to 1992 fairly dramatically. That allowed the economy to grow at a pace that was more able to afford our collective stupidity. And I suspect what happens in the next 10 years is not dissimilar to what happened then. I expect ultimately that the market will get in control of the long-term interest rate, not the Fed. That'll have fairly profound implications in terms of the cost of capital. And I believe that 10 years from now, I hope, we will slow the rate of growth in government expenditures and hence government debt. I think with regards to entitlements, that we will reform entitlements. I think as an example with Social Security, they'll say to some fat old rich guy, Rick Rule, the idea that your taxation for Social Security ends at $160,000 income is going to go away. You're going to have to pay just like everybody else at all levels of income. In other words, there's going to be a huge tax increase for productive shareholders, productive taxpayers. The second thing that happens is they're going to look at me and they're going to say, no matter how much you put in, we're going to means test it because we can't afford to pay you. So there's going to be a straight transfer in Social Security where they steal money from folks like me in terms of how much they tax, and they don't pay them anything. The other thing that's going to happen, and it should happen, they're going to means test all entitlements, but they are going to increase the eligibility years in Social Security. When Social Security was instituted in the United States, it was meant to provide poverty-level income from age 65 on. That's an important stat, because the average life expectancy of an American male at the time they instituted Social Security was 66 years. So the program was meant to sustain the average American at a poverty level of existence for 1 year. The average life expectancy of an American male is much longer now. The consequence of that is that the eligibility years for Social Security needs to go up. It needs to be expanded from its current 62 to perhaps 70 or 72. That needs to happen. And I think over the course of a decade, not over the course of 2 or 3 years, but over the course of a decade, that will happen. The reason that there's a labor shortage is that the price of goods and services in the last 15 years has escalated so much that people are sort of quitting. The minimum wage here is, $7.70 an hour or something. That's not a living wage.
Let's be clear about something. The reckoning isn't coming. It's already here. You can see it in the numbers, but you can also feel it in the culture. We've normalized dysfunction. The market cheers deficits. Politicians brag about debt-funded growth. And economists act like inflation is some mysterious act of God instead of the direct result of policy. Now, I'm not an economist, thank God for that, but I am a student of arithmetic, and arithmetic doesn't lie. If you owe $157 trillion and make $5 trillion a year, you're broke. You can't grow your way out of that. You can't tax your way out of that. You can only inflate your way out of that. And that's exactly what's happening. We're in what I call the dishonest default. The politicians can't bring themselves to say, we can't pay. So they print, they debase, they manipulate interest rates, they pretend 8% inflation is 3%. It's a slow-motion default where everyone gets paid, but no one gets their purchasing power. That's what gold's rally really represents. Not greed, but fear. Not optimism, but realism. Let's take a step back and look globally. The same problem exists everywhere. The Eurozone's drowning in debt. Japan's central bank owns half its bond market. Canada's borrowing to fund consumption. Even so-called resource-rich countries like Australia are importing inflation. It's a global debt bubble wearing a polite smile. But the United States is still the center of gravity. When America sneezes, the rest of the world gets pneumonia. And right now, the US is sneezing debt and inflation all over the global system. Here's a fun exercise. Imagine what happens if the US were forced to pay market rates on its debt. The 10-year Treasury is at 4.5% today. At that rate, annual interest payments already approach $1 trillion. If yields were to rise to match real inflation, say 10%, interest costs alone would exceed total tax revenue. That's checkmate. And that's why they can't allow it. The Fed will keep rates negative in real terms because positive real rates would detonate the entire system. That's why, no matter what politicians promise, inflation isn't going away. It's policy. It's not a bug. It's the business model. So what happens to gold in that world? It does what it's always done. It reflects reality. Over the next decade, if the dollar loses 75% of its purchasing power, gold's nominal price will mirror that decline. If gold's $3,700 today, triple that and you're at $11,000. That's not a wild prediction. That's math. And it's not because gold's getting more valuable. It's because paper's getting more worthless. Now, the interesting part is how psychology will change along the way. For the last 40 years, gold has been treated as an eccentric asset, something your grandfather bought and buried in coffee cans. The media sneered at it. Wall Street ignored it, and millennials bet the farm on tech and crypto instead. But when people start realizing their safe government bonds are losing value in real terms, when their savings buy less every year, they'll rediscover gold. Not as an investment, as money. We've been here before. In the late 1970s, after a decade of monetary abuse, gold went from $35 to $850. That was a 24-fold increase. Silver went from $1.30 to $50, and that was before the internet, before ETFs, before global retail access. Now imagine what happens when that kind of panic plays out in a world with instant information and algorithmic trading. When confidence breaks, it doesn't fade, it shatters. We saw a small taste of that in 2020 when the world realized supply chains weren't infinite and paper wealth wasn't food. Gold spiked, silver doubled, and physical demand wiped out inventories overnight. Dealers couldn't get product. Premiums exploded. That was a dress rehearsal. The next act will be global. And the funny thing is, even as gold surges, the mainstream will miss the message. They'll treat it as a speculative bubble. They'll drag out economists to say it's overbought. They'll call it irrational. But there's nothing irrational about seeking shelter when the roof's on fire. Here's a tweet I saw recently that nailed it. Gold isn't going up. Paper's going down. At Sound Money Guy. That's it. That's the whole story. And by the way, the same dynamic is starting to creep into silver, which in my opinion, remains the most underappreciated monetary metal on Earth. Silver isn't just a hedge against inflation anymore. It's the backbone of modern industry. Solar panels, electric vehicles, medical tech, AI. They all need silver. You can print dollars, but you can't print conductivity. And global production is stagnating while industrial demand explodes. We're already in multi-year supply deficits. Recycling can't fill the gap. When investors wake up to that, you'll see a move that'll make the 1980s spike look tame. Gold will be the headline. Silver will be the riot. Now let's talk psychology again, because this matters more than most people realize. Most investors, and especially the younger ones, have never lived through a genuine inflationary decade. They've been conditioned to believe that central banks can fix everything. Print money, cut rates, jawbone the market, rinse and repeat. It worked for 20 years because we had disinflationary tailwinds. Cheap energy, cheap labor, cheap credit. Those are gone. The new era is one of scarcity. Labor costs are rising, energy's tightening, and globalization is fracturing. You can't paper over those with 0% rates. That's why I say the reckoning is not ahead. It's now. And here's the thing. As painful as this is, it's also an opportunity. Because when faith in paper dies, the smart money moves early. You don't buy gold at $10,000. You buy it at $3,700 when everyone else is distracted by meme stocks. You don't buy silver at $150. You buy it at $50 when analysts call it boring. You don't wait for CNN to tell you it's time to hedge. By then, it's too late. So my message to viewers is simple. Get your financial house in order. Own productive assets. Own some cash for liquidity. But most importantly, own real money. Because when the next decade plays out, it won't be about who made the most. It'll be about who lost the least. That's not pessimism. That's prudence. And if history's any guide, those who hold real money through dishonest defaults don't just survive, they thrive. Gold doesn't lie. Governments do. That's why after 50 years in this business, I still sleep well at night.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.